Welcome to Iron Financial. This is the place we forge stronger portfolios by hammering right through the market noise. I'm your lead analyst. Today, we are taking a wrecking ball to the latest earnings report from American Eagle Outfitters. Look, they just posted numbers that absolutely blew the doors off Wall Street expectations, and the stock surged. From the outside, it looks like a fortress of profitability. But you know our job isn't to stand outside and admire the facade. Our job is to run a full structural stress test. We're here to find out if this company is built on solid bedrock or if it's just a house of cards waiting for the first strong wind to blow it all over. And that really is the multi-billion-dollar question, isn't it? I'm your market skeptic, and it's my job to find those hairline fractures before they turn into catastrophic failures. I mean, the headlines are screaming victory, I'll give you that. But you and I both know plenty of beautiful-looking buildings have crumbled into dust because of a flawed blueprint. So today, we're not just going to read you the press release. We're putting on the hard hats and doing a full forensic inspection. Is AEO a genuine turnaround story that you can build a position on? Or is it a classic value trap, beautifully engineered to pull in your capital right before the floor gives out? Let's get to work. All right, let's get right into it. Let's start with the heavy artillery, the top line beat. AEO posted a record fourth quarter revenue of $1.8 billion. And let's be perfectly clear here. That's not just a good number, that's a statement of pure force. In a retail sector that is literally littered with casualties right now, they didn't just meet expectations, they shattered them. This is the highest Q4 revenue in the company's entire history. That is the kind of raw power that forces the market to stop, turn its head, and pay attention. But revenue, as we all know, is just the opening shot. Let's talk about what's actually hitting the bottom line. Let's talk about profit. Adjusted earnings per share, or EPS, clocked in at a powerful 84 cents. Now, to put that in perspective, the consensus on the street was hovering around 71 cents. That's a 13-cent beat, a 16% positive surprise. Now, what does that signal? It signals that management isn't just moving a bunch of inventory. They are demonstrating real operational discipline and converting those massive sales into tangible, cold, hard profit. And here is the final blow in this opening 1-2-3 combination, a 10% year-over-year revenue increase. You have to understand, for so many apparel retailers right now, just being flat is the new up. So posting double-digit growth, that is a signal of absolutely ferocious momentum. This proves the second half of the year wasn't some kind of fluke. Management found a gear that most of their competitors can't even seem to find. So yeah, the headline case is strong, very strong. But here at Iron Financial, we don't get paid to read the headlines. We get paid to read the fine print. So here's our blueprint for today's deep dive. First up, we're going to properly examine that headline beat and really establish the core of the bull case. Second, we're going to isolate the company's true growth engine. That's the Aerie brand, and see exactly what is holding this entire structure up. Third, and this is where the real work begins, we put on our hard hats, grab our flashlights, and we inspect for any cracks in the foundation. Fourth, we'll analyze management's supposed plan to repair those cracks. And finally, number 5, we deliver the Iron Financial verdict. Is AEO a genuine opportunity, or is it a sophisticated trap? Okay, let's dive right into this first section, the headline beat. Look, before we start challenging these numbers, we have to respect the sheer force of them. This wasn't some narrow win. It was a complete blowout across nearly every single important metric. This is management's best attempt to build an undeniable case that their strategy is firing on all cylinders and that this momentum is for real. Now, what's really interesting here is just how comprehensive this performance was. This isn't just one metric looking good in isolation. No, it's a cascading effect. You see total comparable sales are up a powerful 8%. Okay, great. But then you see that adjusted operating income exploded by 27% year over year to $180 million. And then you look at the operating margin, it expanded by 130 basis points to over 10%. This tells a story of leverage. The higher sales are driving higher profitability, which is then fueling much higher income. On paper, this is a perfect picture of a well-oiled machine firing on all cylinders in the fourth quarter. And of course, here is management taking a well-deserved victory lap. The CEO, Jay Schottenstein, his words are meant to reinforce that narrative of control and pinpoint execution. He specifically highlights strong execution and reignited growth. But you know the key phrase to focus on here? It's back half of the year. This wasn't a full year blowout, not by a long shot. The company had a brutal start to the year, and they know it. So what they're claiming is that they implemented a deliberate, strategic shift, and this report is the result. This quote is designed to instill confidence that their success isn't just some random chance, but the direct result of a concrete plan that is working. But let's be forensic about this. Where is this so-called reignited growth actually coming from? That brings us to our second section, where we put the company's undisputed power source directly under the microscope, the Aerie brand. Because when we analyze the architecture of AEO as a whole, Aerie isn't just another part of the business. No, it's the central, load-bearing pillar that's holding up the entire roof. The performance of the entire company, frankly, rests on its structural integrity. And this chart, wow, this chart just brilliantly illustrates that dependency. The disparity here is absolutely stark. Aerie's comparable sales skyrocketed an incredible 23%. Just unbelievable. Meanwhile, the namesake American Eagle brand, well, it just limped along at 2%. This is not the story of a healthy, diversified portfolio of brands all pulling in the same direction. No, this is the story of one superstar brand doing all of the heavy lifting, masking the stagnation in the core business, and single-handedly dragging the company's total comp sales up to that impressive 8% figure we saw earlier.
Okay, hold on a second. I see the 23%, and yes, it's spectacular. President Jennifer Foyle calls the strength broad-based. Fine. But can one pillar, no matter how strong you tell me it is, truly support the weight of the entire enterprise forever? A 2% growth rate from your flagship brand, the name on the actual door? That isn't just weak, it's anemic. To me, it sounds like the foundation of the original house is starting to rot, and they've just bolted on a beautiful, shiny new wing to distract everyone from the smell. Is this sustainable? Or is Aerie just a powerful but ultimately temporary fix for a much deeper, much more structural problem?
That is the billion-dollar question, and it's exactly why we have to stress test that pillar. So let's do it. The data here suggests it's not just strong, it's actually getting stronger. This doesn't look like a one-hit wonder. New customer acquisition at Aerie surged 14%. Brand awareness climbed 12%. Now, these are not lagging indicators, these are leading indicators of future demand. They're actively building a wider, more loyal customer base. And on top of that, the offline activewear sub-brand is delivering what management calls an incredible quarter. The strength appears to be broad. So while the dependency is a clear and present risk, you are absolutely right about that. The evidence suggests this pillar is made of reinforced steel and they're still building it up. Okay, I've seen the glossy architectural renderings, I've heard the sales pitch. Now it's time for the real work. It's time for skeptics' inspection. We've admired the fresh coat of paint and the impressive numbers they put on the surface. Now we're going down into the basement with a flashlight to look for the cracks in the foundation, the structural weaknesses that the headlines and those CEO quotes are specifically designed to make you overlook. And that is precisely the right question to be asking. The market, it gets mesmerized by big revenue growth and flashy EPS beats. But the real risk, the kind that can wreck a portfolio, is often buried pages deep in the financial statements. So what is the pressures that management isn't putting in the first paragraph of their press release? What are the red flags that are keeping the smart institutional money on the sidelines? Let's start digging. And here it is. This is the heart of the bear case. Let's break it down, point by point. First, gross margin. Despite a 10% sales explosion, their gross margin declined by 30 basis points. Now, how does that even happen? It means you're making less profit on every single item you sell. That is a massive red flag, signaling serious margin compression. Second, tariff impact. They took a $50 million hit from tariffs in this quarter alone. That is a direct tax on their profits, highlighting a major vulnerability in their global supply chain. Third, insider selling. Executives unloaded roughly $6 million worth of stock recently. If the future is so bright, why are the people with the most information taking chips off the table? And finally, analyst consensus. The average rating on Wall Street is a hold. The pros are not telling their clients to pile into this thing. These aren't opinions. These are material facts that fundamentally challenge the bull narrative. And let's just hammer this point home because it gets completely lost behind Aerie's blindingly bright numbers. The core brand, the name on the building, American Eagle, is growing at a pathetic 2%. And it gets even worse. If you dig into the earnings call transcript, it reveals the women's business within that brand was completely flat, zero growth. The men's side carried all of that meager 2%. So what you have is a house where one half of the main floor is showing zero signs of life. How long can you possibly sustain a structure when your foundational brand is effectively on life support? This isn't just a crack, it's a fissure running right through the foundation. Those are all valid, incredibly serious concerns, and any credible analysis has to put them on the scales. But that brings us to our fourth section,
management's strategic blueprint. Now, the bulls will argue that management isn't ignoring these cracks. They'll say they see them and they have an articulated plan to repair the foundation and reinforce the overall structure. The question for us is whether this blueprint is actually viable, or if it's just wishful thinking on a piece of paper.
And here is that supposed plan. These are concrete, actionable steps they're taking. First, they are basically admitting the core AE brand has a relevancy problem, and they're attacking it with a 50% plus increase in advertising spend in the first half of the year. Second, they're demonstrating some capital discipline. They're divesting their third-party logistics business, Quiet Logistics, to stop the financial bleed and refocus on their core competency, selling apparel. And third, they are actively renovating their real estate portfolio. They're shuttering 25 to 30 underperforming American Eagle stores and reallocating that capital to open 35 new high-growth Aerie and offline locations. This is a classic capital allocation strategy. You starve your losers and you feed your winners. So the crucial point here is that these moves aren't just for show. They have a tangible financial impact. Exiting the logistics business and other restructuring is projected to generate about $20 million in net annual savings. This isn't just a story. It's a plan designed to directly improve the bottom line, fortify the balance sheet, and free up that precious capital to reinvest into their growth engine, Aerie. This is exactly what a proactive management team is supposed to do.
Whoa, hold on. Let's be realistic here. A renovation of this scale is never free. And this is the critical counterpoint. That $20 million in annual savings sounds pretty good until you realize it comes after they take an $85 million restructuring charge just to pay for it all. And the tariff issue? That's not going away. They're guiding for another $30 million tariff impact in Q1 alone. So in the near term, the cost of these repairs is staggering, and the external pressures are absolutely relentless. The real question is whether they can survive the demolition phase to ever enjoy the finished product.
Which brings us right here to the final weigh-in. We've seen the powerful bull case, built on a monster earnings report. We've stress-tested the bear case, which is focused on the cracks in the very foundation of the business. All the evidence is on the table. It is time for the iron financial verdict. Is this an opportunity you can build on, or is it a trap just waiting to spring?
Let's put it all on the scales, right here, right now. The bull case is heavy. You cannot argue with record revenue and a huge EPS beat. You can't deny that Aerie's 23% comp growth makes it a true powerhouse. Add in a clear strategic plan for savings and the fact they returned over $340 million to shareholders last year, that is a compelling case for strength. But the bear case is just as formidable. Gross margin pressure is a real, tangible threat to profitability. The continuous tariff hits expose a major operational risk. The core brand is stagnant, which is a long-term existential threat. And you simply cannot dismiss insider selling and a neutral hold rating from the street. This is a true heavyweight fight.
And that brings us to the synthesis. After examining both sides of this, the conclusion is clear. The structure is not a house of cards that's on the verge of immediate collapse. It is sound, but only for now. It is very, very clearly a major renovation in progress. You are not buying a finished home here. You are buying a construction site. And the most critical component of that entire site is that the future of this company rests almost entirely on that one single load-bearing pillar, Aerie. If that pillar shows any sign of fatigue, the entire investment thesis comes crashing down. So here is the final iron financial verdict. American Eagle Outfitters is not a simple buy or a simple sell. It is a high-torque growth engine, that's Aerie, that has been bolted onto an aging legacy frame, that's the core AE brand. The power is undeniable, but so is the risk of that underlying structure failing. This is an opportunity, yes, but it is specifically an opportunity for investors who can stomach the volatility, the noise, and the very real risk that comes with a major construction project. This is not a finished, impenetrable fortress. You must decide if you are a venture capitalist willing to fund a high-risk renovation or an investor looking for a move-and-ready castle. The choice and the risk that comes with it is yours. That's our analysis. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.